Matt, what is your biggest takeaway of the new Fed Chairman Paul's congressional testimony today?
Well, I think he was very open and honest, as we expect from our Fed chairman and women now. But again, he's talking about inflation the most. I think that's the most pressing concern about what the market anticipates from him. Can we get to that 2% threshold? How will we get there? With some of the data that we saw, was it more of a one-time event, or was this something that's more sustainable, where we see inflation uptick that would require further rate increases? So that's what the market is looking for, and I think that's why we're down fractionally as far as the Dow goes. The S&P is down a little bit more, but that's not so bad considering the gains that we had yesterday. So none of what he's talked about has been too much of a surprise. It's been pretty transparent, and we hope that that's the way he continues to run his regime going forward.
And we all know along the time that the longer term the inflation is 2%. So how long do you think that we can actually get that?
Well, you know what? They can't really get to that number yet, and they understand that some of the fundamental changes that have gone on in the economy and worldwide, but there's definitely U.S. growth, there's worldwide growth, so we see some of these prices being able to be pushed onto the consumer. The recent tax cuts have helped the consumer as well, so all of this will be probably worked into the equation as we take in all of 2018. So it's not going to just happen overnight. It's going to happen a little bit longer over time. So it's going to take a little while. We're going to get a rate increase in March. I think that's already baked into the market. The question is how many more are going to take place? And if so, if he's talking about 3 or 4, how data dependent is the Fed going to be? And under Chairwoman Yellen, that's what we saw. They were very data dependent, and that's why we didn't see those rate rises.
And as Paul mentioned today, that market volatility won't stop more rate hikes. So how to define, what does the more rate hikes mean? Should we expect more than 3 times this year?
Well, I think volatility is reverting back to the mean. Last year was a highly unusual year that we did not have any volatility. So now we're getting all of it in the first month or month and a half. It's surprised investors. We've gotten kind of complacent. So they shouldn't look at market volatility as an indicator of when they should raise rates and when they should cut rates. They should be data dependent, as they said they are. So I think that's an important distinction. Market volatility certainly can probably be a factor they look at, but I don't see it being a driving factor. So market volatility is actually good, and market volatility can mean that there's upside moves as well, as we saw yesterday and Friday. So all in all, it's a good thing. It kind of wakes people up and gives them an opportunity to say, hey, I've got to reevaluate some of my risk profiles.
And how many times your expectations?
He was pretty adamant about saying, everyone's anticipating 3, possibly 4. There was a comment that he said that, if the number doesn't get to 2% inflation, we have the potential to cut rates, which was surprising. So I think 3 is probably a pretty good standard. I think it's pretty safe. The December rate hike of 2018 is about 25%. So it's not assured that we're even going to get that 3rd rate hike yet. So we got to wade through a lot more numbers before we see it. But I would probably hold at 3. I think that's a reasonable number.
Let's switch to the oil market, and the oil market oil trading near 3-year week high on the inventory numbers. So what's your prediction on the upcoming inventory data?
Oil's been very stubborn up here, and it really has been very close range for a while, but it's been ticking higher. Every time it looks like it wants to fail, it holds and breaks out to a new high. So it's very interesting. There was a study that came out that U.S. gas prices have gone down for 2 weeks. That's despite oil being at highs. So that's an interesting little dynamic. But I would anticipate with the U.S. Producing as much as they are and not involved in the quota cuts that have gone on, that's eventually going to be put back into the market, and it's going to try to be absorbed. So it's going to take I don't see oil breaking out any higher, but I've been kind of negative on oil for a while. But again, I think with the headwinds that they're going to face and the U.S. inventory that's coming online, it's going to be hard for oil, I think, to break out any higher.
So how to trade oil, or just something
my guess is that you're still going to be able to buy a dip and that dip may be below 61. That's where it held last time. If it breaks 61, then you start to worry about some of the people that have maybe locked in some gains that they've had. There's been some enormous run up, and if you've held oil for a considerable amount of time, you may say, you know what, this break I want to lighten up. And you probably can sell oil if it breaks out at all above 65, because that now breaks through bands. But I think in between here, it's almost, unless you're going to trade it for a very small fraction of number or, cents or dollar, it's very limited trading range. And that makes it very difficult to trade. That's why the professional traders do it.